the lender's appraisal said it wasn't worth 80 million, it was worth 113.
Wow.
$33 million on paper, at least.
Right.
$3 million value increase. Well, the total equity in the deal was only 26 million. So if that's true, the equity went up by over 100% the day of closing. Now that makes me happy. Number one, because it's a huge margin of safety increase, which is measured, of course, by the debt service coverage ratio. And secondly, it tells me that there's pretty likely that this, even if it loses some value, there's a big cushion there. Third, it tells me that it's likely going to be pretty profitable, especially since we did it with an operator who's done 89 deals like this successfully.
Check out the website simplepassivecashflow.com for podcasts, videos, articles, and free e-courses. If you guys have any specific questions, feel free to reach out to the team via email and we'll get you pointed in the right direction, whether it be an educational course or information about syndication deals. If you haven't read my book, The Journey to Simple Passive Cashflow, click the link below to get a free copy. Thanks to John and the Wealth and Freedom Nexus podcast. Our team is here to help you take the first step, or if you're a seasoned investor, then we're here to expand your reach into alternative investing.
Are you tired of trying to keep ahead in the rat race, only to have so much of your hard-earned money going to the tax collector? Equity doesn't pay the bills. Retirement savings don't pay you now, and there are only 24 hours in a day to work. The only solution is passive income that pays you 24/7 now, not 40 years from now. From vetted investment opportunities to tax saving strategies. Let John guide you through all the confusion and take control of your financial life in pursuit of financial freedom. So sit back, relax, and welcome to the Wealth and Freedom Nexus.
You know, for the most passive returns in real estate investing, I like to put my money with Freedom Family Investments, a team I personally trust because they pay me steady streams of cash flow, hassle-free, all while doing the things I love. Returns are better and more reliable than the stock market, up to 12%. I love that tax benefits offset capital gains or your W-2 income. For a little insider pro tip, knowing who to trust is key to success in investing. Freedom Family Investments has a perfect track record of paying their investors right on time. To learn more, text family to 66866. If you want to invest on autopilot with people I personally trust and with a team who cares about you reaching your financial goals, go ahead and text family to 66866. Hey there, welcome back to another great episode of the WFN podcast. John Rickgarn, your host, as always, investor, educator, and realtor. Now, we actually have a returning guest coming back on the show. It's actually been quite a while. Actually got to double check here. Yes, our guest today is Paul Moore, who came to us last on episode 21. This is back of March 9th, 2022. Hard to believe that was over a year and a half ago. But if you haven't heard or watched that episode, be sure to check that out first, kind of get a little backstory where we basically just talked about self-storage. You know, why would you want to invest in self-storage? What are the growth opportunities in that? Why is it kind of, you know, a hidden gem, so to speak, as far as the uses of it as well as the growth of it? And, you know, a little bit more, I don't think anything is recession proof, but I do think there's a lot of recession resiliency built into it. That said, I wanted to have Paul back on this podcast a year and a half later, because a lot of times, you know, we've seen a lot of turmoil in the market, especially in the overarching space of commercial. Commercial obviously covers everything from multifamily to office to industrial to storage and, you know, everything in between. And I kind of wanted to get Paul's take, is he still investing in self-storage, or has he taken a step back? Has he recently invested in self-storage, especially with the economic climate we're in? And I say economic climate with the Federal Reserve jacking up rates starting in 2021, soon after Paul was last on to 2021, but a big increase in rates starting in early 2022, about the time that Paul was on. And we've seen the fastest increase in rates in 40 years for what you could get for, generally speaking, non-QM investor loans at 4 or 5%. Now you're looking at about 8 or 9%. So it's just kind of curious, is Paul still investing in self-storage? And furthermore, has he invested in any new deals since he was on? So be sure to tune into that. Also going to talk a little bit about a new interesting investment space that he has gone into. Not to say that I will or will not go in this space, but definitely does seem like there's some potential, maybe not immediately, but definitely long term. And also with this investment space, there is another added bonus that it's kind of been Airbnb'd, so to speak, if we can verb that. So be sure to tune into that or stay listening so you don't miss out. I'll also be talking about a little thing called preferred equity. What is that, and how does Paul offer that to the investors? And then finally, one topic I really want to hone in on. Unfortunately, I don't think it's talked about much, especially in the mainstream media, but it just comes down to human trafficking. I think you'd be surprised at just how much revenue comes from human trafficking. And Paul actually will give an example in the podcast, and just really is kind of mind-blowing exactly the money behind it. If human trafficking per se was a publicly traded company, was a company, it would blow out of the water the revenue, the profits of Apple and Starbucks and Nike and many of the Fortune 500 companies, global companies we know of. It would just blow them out of the water. So kind of wanted to talk on that. Maybe you've seen the movie Sounds of Freedom. That was in the theaters in 2023. And unfortunately, human trafficking is still a very real, really part of our lives. Wish it wasn't. Wish I could flip a switch and never had to worry about human trafficking. But unfortunately, that's not the world we live in. But however, there are ways to help combat that problem. There's ways to increase revenue and raise funds and donate to reliable organizations that can help with the crime of human trafficking. And we're going to finish on that with a podcast today of Paul, of what Paul Moore, his company, Wellings Capital, what they're doing, what their commitment is to really put a stop to human trafficking, what they're doing, putting their money where their mouth is. So it's not just about investing, it's not just about making money, but it's about improving society and leaving the world in a better place than when you started. So with that, we will get into today's interview with Paul Moore after a word from one of our longtime sponsors.
Check out the website simplepassivecashflow.com for podcasts, videos, articles, and free e-courses. If you guys have any specific questions, feel free to reach out to the team via email and we'll get you pointed in the right direction, whether it be an educational course or information about syndication deals. If you haven't read my book, The Journey to Simple Passive Cashflow, click the link below to get a free copy. Thanks to John and the Wealth and Freedom Nexus podcast. Our team is here to help you take the first step, or if you're a seasoned investor, then we're here to expand your reach into alternative investing.
Hey, Paul, thanks for coming back on the show. How are things in your world?
John, it's such an honor to be here again. I'm doing great, and I got news.
You got news?
My kids are 98 years old.
Okay.
four combined. And the first one's getting married next weekend, so I'm heading to California.
Oh, fun. All right. Well, congrats on that, and hope that goes well for you.
Yeah, man. So
well, as I alluded into the intro, it's been about 1.5 years since you were last on the podcast. And during that time, Uncle Jerome and his, Fed posse, they decided to basically double interest rates, fastest increase in, 40 years. They said it was the highest since, I think, 1980. I'm like, well, geez, that was before I was born. But with all that being said, interest rates market, are you and Wellings Capital still investing in self-storage?
We are investing in self-storage, and I'll tell you one reason why. Buffett says it's not about it's not the main issue in risk is how much you pay. And of course, there's other big issues, which is how great is the operator and all that. But I mean, here's a couple examples, John. We recently invested in a self-storage facility in Henderson, Nevada, which is a suburb of Las Vegas.
Oh, sure.
And the previous owner had owned it since she built it. Her family built it at least 40 years ago. It had homeless people in the units. It had non-paying tenants. It was a total mess. I don't know that it had any quality sign. I don't think it had a website. And amazingly, they were charging $60 a month for a 10 by 10 unit. And the going rate in the market was at least, well, I'll just say an average of 148.
Wow.
So when you can get deals like that, go in and clean them up, fix them up, raise the rates by literally way over double and still be below market, and then add a website, put some shrubbery in, paving in, nice sign, great manager. It's pretty safe. And it's even safer when it's bought for cash, which this one was. Now, I will say that it's likely once this is stabilized in the next several months, they'll probably put 50 or 60% fixed rate debt on it. But, honestly, I mean, if I'm not going to tell you what the price was, it was in the $3 million range. But I mean, if you use the value formula for commercial real estate, just increasing the rents, the occupancy, the payments, everything else will significantly increase the value before we put that 50% debt on it. So that's an example, one of many, of why we're still doing self-storage.
Yeah, like you said, if you can increase the income and obviously take a rather not well-performing asset, not well-managed asset, turn it around, obviously some opportunities still in the market. And thankfully you and Wellings Capital were able to capitalize on that.
Yeah, it's really true. Now, to be clear, we're not the operator. We go out and try to find the best of the best operators that we can identify. And though there's no guarantees they'll perform well, most of the ones we have so far have. Some of the ones we got in the last decade, that we still have investments with are struggling. But, for full disclosure, the folks we've been investing with this decade have been honestly really, really solid. I mean, another self-storage deal that comes to mind is somebody called one of these operators and they said, remember, we've been calling you since 2014. And the guy said, yeah, I know.
Oh,
well, I put a bunch of my own family's equipment and dirt bikes and RVs and friends stuff in there for free. Would you still pay me what you offered in 2014? And the answer was, let me think about it for a while. Yes.
Yeah.
So, yeah, that was, I mean, it's just when you're getting deals like that, you're still going to, hopefully be investing.
Okay. Makes sense.
Another thing too, is we're investing in pref equity now as well, if you're familiar with that.
I'm actually not. And if I'm not, I'm guessing that one or two of my listeners probably aren't as well. So why don't you give us an input on that?
So preferred equity has some of the characteristics of debt and some of equity.
Okay.
And so right now, a lot of the equity is, that people are investing in is not really penciling out where it used to. It might have penciled out in the 18 to 25% annual return rate, and people were getting even better than that in the last decade. But a lot of those are penciling sub 2 digits right now, so below 10%. So debt seems like a pretty good option right now. Sometimes you can get private lending, private debt, paying you 8, 9, 10, 12%, which is higher than usual. Where pref equity has some of the characteristics of both debt and equity. There's not a lien, but often we get a personal guarantee from high net worth founders, sponsors. Often we get paid in advance for a year. Reserve. And what happens is the typical current pay on the pref equity deals we've done, and we've done 4 of them, we're on our 4th one this week, is around 8, 9, 10, 12%.
Okay.
And then the upside on top of that, when the deal is refinanced or sold, the upside to us is an additional 7 or 8%. So we're looking at, total coupon rates of 15 to 18% on these deals. And they're below, or I should say, they're in front of the common equity. So they're safer, theoretically, than the common equity. The common equity serves as a layer of protection behind or above us in the capital stack. And so we really love it. And it's providing more cash flow into our fund while we get those deals like the two I mentioned earlier rehabbed, and our operators get them, to where they're cash flowing themselves. And so that's why we like pref equity.
All right, interesting. So now, speaking of additional investments and maybe just opportunities out there, recently you had mentioned a recent article or your newsletter. You've added RV park investing. Can you tell us a little about that? How did you get into that, and what did you see as the pros and potential growth in that space?
Yeah, we wanted to do RV parks for years, John, but RV ownership is up since 2000 till the middle of COVID. It was up 62%. And while only about 12 million folks have RVs, about 8 or 9 million more say they want to buy one.
Okay.
Unfortunately, the interest rates have caused a lot of people to put the brakes on that, but never fear. The Airbnb and Uber model has come to the RV world. And here's what that means. An RV typically sits idle about 49 or 50 weeks every year, as you can guess.
Yeah.
But any owner of an RV of any type can now put those on a platform called Outdoorsy, or another one called .com, and turn those into a rolling rental unit. In fact, my friend in Colorado, one of our investors, actually put one of she bought an RV for $80,000 about a year and a half ago. She put it on RVshare or Outdoorsy for the first 6 months, and she made $40,000 free and clear out of that $80,000 she spent in just the first 6 months. And I haven't talked to her in about a year, so I don't know how she's doing this year. But it's a really powerful thing, especially in a fledgling economy, because a lot of people who can't afford to go to Disney or don't want to take a trip to Europe, they'll still do an RV trip. And now that you can rent an RV and you can even get them to come set it up for you. So I could drive to a Blue Ridge Mountain RV park and have the RV set up for me when I arrive, and I won't even have to drive it if I'm, nervous about that. Just speaking for my wife, of course.
Sure.
And if I was worried about it breaking down along the side of the road, again, speaking for my wife, they have 24-hour service. They can come out and pick you up and take care of the RV and all that. So it's pretty dialed in. But there's one more thing that makes the RV park realm so powerful, and that's this. We have just witnessed a first in world history. And John, I can confidently, people say stuff like that, but you're like, well, I don't know if that's true. But I can confidently tell you, and you'll agree, that we've just witnessed a first, and that is the remote work revolution. Since COVID, and of course, before COVID, there was the number of remote workers from 2010 to 2020 had gone up some astronomical number. But since COVID, we all know that it's gone up much more because people tried it and it worked. There are 56 million people who can work full-time remotely.
Wow.
and there's 36 million more who have been able to work part-time remotely. And so as a result, a lot of these folks at the same time, they realized, hey, I almost died, or I knew 3 people who died during COVID. I think I really want to take stock in what's important in my life. And what's important to me is my family, my life, my blood pressure, my entrepreneurial opportunities. And so a lot of those folks have hit the road. In fact, a CEO of a tech startup that I know nearby, he bought a $50,000 RV and he outfitted it with desks, and he outfitted it with all kinds of fun equipment, and he took off and he hit the road. Last I talked to him, he was in Colorado.
Wow. Interesting. And I'm kind of thinking of this too. Personally, this is just my preference. My wife and I aren't into the RV space, but I know many people are and have always thought about it. And I'm just thinking, well, gosh, I don't even know the model to mention. I want to go with this XYZ RV, but wonder how it would work, wonder how it fits. Hey, here's an opportunity that I can rent it and stay in it for a week, 2 weeks, 3 weeks, see how it feels. And then, okay, if I like it, I can buy it, or I can just decide to, be the Airbnb guest for it.
Yeah. So think about what the Airbnb thinks. So let's say those typical RVs been sitting idle 50 weeks a year, but now that same RV is put into action for say 30 weeks a year, and multiply that times thousands of RVs out there, and the remote work revolution and the record sales we had in RVs in years like 21 and 22, I believe. Add all that together, and there's incredible pressure on a limited number of RV parks. And so this is why we're not investing in RVs, we're investing in RV parks. And this is why I love this space. Another thing I love about it, John, is there's a handful of really good professional operators like Sam Zell, his company, God rest his soul, and also Sun Communities. But there's a whole bunch, as in thousands of mom and pops who don't have the desire, the knowledge, or the resources to really operate well and to maximize the value to investors. And so for us as an investor, we see this as an incredible opportunity, sort of like, and again, we can't prove this, but we believe it's like getting into self-storage about 30 years ago.
Gotcha. Makes sense. And, it's kind of interesting. You're talking about the growth of RVs, the RV space. I still remember with the Great Recession where I think it was Indiana. I think it was a facility in Indiana. They were like shutting down operations. People were, stopping building RVs and not a lot of demand. And here we are 15 years later. And obviously that's done a 180. So, could definitely see some growth opportunities there and hopefully some investing opportunities. So higher up, Paul, and I know neither one of us have a crystal ball. It could say August 24th of 2024, this will happen. But, what are your thoughts for 2024? What do you think is going to happen in the finance world, investing world? I mean, personally, I think being an election year, I do think rates are going to probably drop a little. However, it might be a little too low. Too late for some operators with, balloon payments, floating debt, bridge debt out there. They, might go under, you've had a lot more years of experience than I have. What do you foresee in 2024?
Well, one thing that the Fed governors who were polled and the SOFR forward-looking curves, which were developed privately, agree on is a 1% drop next year.
Okay.
Now, where they diverge is the SOFR future-looking curves say that after that 1% drop, it's going to go flat for years.
Okay.
The Fed governors who were polled say they believe it will drop 1% a year for 3 years.
Really?
Yeah. So that news came out earlier this week. I personally would have agreed with the SOFR forward-looking curves. But when the governors say that's their opinion, that obviously carries a lot of weight. So I think you're right. It's far too late for a lot of syndicators who are already losing their deals back to the bank. Did you know? So for years, I've been crying wolf, I guess, about multifamily. And, hey, watch out. It's not the perfect investment, no matter what that guy said in his book. I'm the guy, by the way. It's not the perfect investment if you have to overpay, over leverage, and assume huge rent increases and no cost increases to make the deal work. So I've been saying that for years. But one thing I didn't realize would happen is the huge increase in reserve requirements that these lenders are correctly imposing on the folks with floating rate debt and a rate cap, because the rate cap, this is two real examples. One of a friend of mine said that his rate cap payment that he was putting in reserve was $1,000 a month, and the lender increased it to $89,000 a month. Can you imagine how?
Wow.
I mean, it's a huge property, but how are they going to absorb the fact that their rate already went up a huge amount? Maybe it didn't double because of the cap. But now their rents didn't go up as much as they projected. Their costs of doing business went up more than they projected. And now they have to set aside $89,000 a month for a rate cap replacement. That's a real example. And somebody else in the group said, yeah, mine was $2,000. It went up to $70,000 a month. How are they going to do that? Well, the answer is they've stopped distributions to their investors, and that's in those cases. But the answer could end up being they lose it back to the bank, which the lender, I just hate to hear that, but it's probably, well, we already know it's happening.
Yeah, I know there was that one in, I think it was Houston. There was like 2,400 units went back to the bank. I know there's others. And I was kind of in your same boat as you. I still remember we were at the Summit on Sand in Belize back in 2021, and Ken McElroy was talking. I mean, Ken's been known for years as a multifamily guy, tens of thousands of units, or 10,000 units, whatever the number is. And he was sharing, it's like, yeah, we actually started selling. Numbers early aren't making sense. I think we're gonna put a pause. And I just kind of looked at it's like, okay, this is a guy that's been in this business for decades. He knows this inside and out. He's done this for quite a while. If he's taken a step back, should I maybe be a little more cautious when I won't name any names, but some syndicators of, hey, invest with me for this multifamily project. And truth be told, this was before interest rates went up, and now the numbers are even less appealing. And okay, on paper it might look good, but like you said, if you don't get distributions, the returns on paper don't mean anything.
Right. So when would it make sense to invest in multifamily? There's probably an infinite number of answers.
For investors seeking DSCR financing, check out timothyhero.com. The guy has closed over 150 DSCR loans in the last 2 years and has been appearing on podcasts and written about by journalists. He's well connected with some of the best lenders in the game and can get you the financing for your rental properties.
But Wellings Capital has decided that there are at least a couple times. Number one, when the operator is buying a distressed asset that already has, like it's already on the way back to the bank, or it's even, come out of a bank. We haven't seen a lot of those, but we believe that that's possible. Number two answer is when there's a tax abated deal. So tax abatement deals in high tax states like New Jersey and Texas make a ton of sense to us, because think about it. If you've got, let's say, $1.5 million tax bill, and that's what you're buying at. Let's say you're buying from a seller who's got $1.5 million tax bill, and the day of closing, you have already worked out a tax abatement structure with the city of Houston, Austin, Dallas, whatever. Now there's zero tax for the next 99 years.
Wow.
And that's transferable to the next buyer. Well, that's what we've been investing in. And literally one recently was acquired for $80 million about 3 days ago, I think.
Okay.
And we invested in that. It was acquired for $80 million. And at closing, the lender, the lender's appraisal said it wasn't worth $80 million. It was worth $113.
Wow.
$33 million on paper, at least.
Right.
$3 million value increase. Well, the total equity in the deal was only $26 million. So if that's true, the equity went up by over 100% the day of closing. Now that makes me happy. Number one, because it's a huge margin of safety increase, which is measured, of course, by the debt service coverage ratio. And secondly, it tells me that there's pretty likely that this, even if it loses some value, there's a big cushion there. Third, it tells me that it's likely going to be pretty profitable, especially since we did it with an operator who's done 89 deals like this successfully.
Wow. Or kind of like you said, back to Warren Buffett and his quotes, having a good deal or a good margin of safety built in there as well kind of makes it a little more palatable for investors.
That's right.
Yeah. Now, one thing I wanted to get into a little bit, Paul, this is one, shall we say, kind of a topic I've never touched base on before. I think it's unfortunately a very, very negative thing in our society. I don't think the media covers it enough. And unfortunately, I think, it's in our backyards. I still remember reading a story that there was some sex offenders. It was actually a crime ring that was broken up in little old Fulda, Minnesota, which I know you're not aware of it, but for some of my listeners, 45 minutes south of Marshall, town of 1,200 people, give or take. Yeah, there was, sex trafficking, human trafficking operation that was blown up. But with this Wellings Capital, I was reading on your website, you made a commitment to really help fight this, really kind of help put some, aggressive tactics behind it and help pursue human trafficking. Can you explain a little bit more on that and maybe the why and how you're doing it?
Yeah, absolutely. If you took the record profits, at least through the year of 2021, of Apple, General Motors, Nike, and Starbucks, added those record profits together and doubled that total, you would have the approximate amount of profit generated by human trafficking every year, according to our U.S. State Department. This is an absolute abhorrent crime that's happening right under our nose. There's more slaves than any time in world history by far. And it's, even since we started this podcast, hundreds of people have been abducted or sold into slavery. Hundreds since we started this show. And so it is a tragedy. My own family has had two close family members to me who have suffered for decades because of crimes committed against them, crimes that a whole lot of children, and especially female children, have experienced. And so I've seen the devastation it's caused. And to imagine that those crimes repeated over and over a dozen or 24 times a day is unthinkable. The problem is, I don't know what to do. I mean, if you saw Sound of Freedom, you saw them do this amazing commando raid, and I want to do that. I'm not equipped to do that. I'm not
right. Neither am I.
Most of our investors aren't. So we had to figure out what to do. And the other problem is, what if you send money off to somebody you don't know and they misuse it and you'll never know? Well, that doesn't feel very good. So we did our own due diligence, just like we do on operators for commercial real estate. And we're trying to find the best, or at least very, very competent, capable, effective, thrifty managers. And we found that in a group called AIM. That's AIM. And the website is aimfree.org. If you go there, you can see what they're doing. They do those commando raids, but they do something else. And they actually don't just bring these children or girls back and set them free, where 90% would end up going back, but they actually give them a new life, a new trade. They pay for food, housing, clothing, and counseling to get them back, to get them on their feet and hopefully give them a new life. And their effectiveness is remarkable. So we've raised $385,000 in the last couple of years, including what we've donated to AIM. But we'd like to make $200,000 more. We'd like to help raise $200,000 more this November. So if you're a listener and you want to be part of that, just let us know. We'd love to have you be part of the match or the gift in November. We don't take any of the money. It all goes straight to AIM.
Sure. And again, with podcast living hopefully infinitely, depending on when you're listening to this, if it's past November 2023, feel free to reach out to Wellings. I'm sure the matches or contributions or AIM will still be around. And, again, it's just very tragic, very wish we didn't have to talk about this. And I think this kind of takes a different toll on even myself. I have a son that just turned 2 this year, and it's like, I just can't even imagine what those humans that have gone through trafficking have even gone through. And so kudos to you and Wellings for, stepping up and partnering with AIM. Again, I'll have that in the show notes if you want to reach out, make a donation, see if you can help hopefully put an end to this horrific crime. So,
yeah, great. Thank you so much for being part of this.
Yeah, you bet. Yeah, like I said, I kind of wanted to highlight that. I mean, we always talk about, hey, how can we invest? How can we, improve our revenues, improve our profits? But at the end of the day, I think we need to do good for the community, is good for humanity even. And this is definitely one way to do that. So,
right.
Well, as we close this out, Paul, and again, I want to thank you for taking the time to come back on my podcast, share, about the RV park space, the possibilities in there, as well as still the opportunities that are out there in self-storage, even with interest rates, the Fed, everything else going on. But if any of my listeners are interested, maybe learning more about you, more about Wellings Capital, and maybe even more about your commitment to fighting human trafficking, what's the best way to reach out and find you?
Yeah, they should definitely come to our website, wellingscapital.com.
Okay.
And they can, if they'd like to get an RV park special report or one on mobile home parks, self-storage, or general commercial real estate investing, they can do that at wellingscapital.com/resources.
Okay.
And we'll give those, we'll send those out free. I've got a couple books on Amazon you can get as well. And if you would like to follow me on Twitter, I'd be grateful. I'm at Paul Moore Invest.
At Paul Moore Invest. And at the time of this recording, Twitter is now actually X, but depending on when you're listening to this, Elon Musk might have changed the name again already. So hopefully we'll see whatever social media platform exists at that time. So, Paul, it's been great having you on the podcast again. Thanks for sharing all the new updates, and best of luck with your commitment also against human trafficking.
All right. Thanks, John. It's been a real honor. Have a wonderful weekend.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.